In 1789, Benjamin Franklin wrote in a letter, "Our new Constitution is now established and has an appearance that promises permanency. But in this world nothing can be said to be certain except death and taxes." And to an extent, this is true. When you think of all the other lessons we've covered so far, many are probably applicable to your life or will be at some point, but some of them are optional. You may never choose to make a budget or buy a home or a car or have a student loan, but it is impossible to not pay taxes of some sort in this country. In this lesson, we'll explore the different types of taxes as well as some key concepts and terminology you should know. Because taxes are a complicated issue both legally and financially, and are constantly changing, it would be impossible in this lesson to cover every detail, but there are a few foundational concepts you should be aware of. First, who can levy taxes? Taxes are always levied by the government. In the United States, there are 3 separate levels of government: federal, state, and local, and all have the power to tax residents, businesses, and commerce within their boundaries. However, they tend to tax different things. Income taxes are levied by the federal government and by some states and local governments as well. Payroll taxes are imposed by the federal and all state governments, and they include Social Security and Medicare taxes that are imposed on both employers and employees. Employers must withhold income taxes on wages, and unemployment tax and certain other levies also apply to employers. Property taxes are imposed by most local governments and many special purpose authorities and are based on the market value of the property being taxed. Schools and some other authorities are often governed separately, and they may impose separate taxes. Sales taxes are imposed by most states and some local areas on the price at retail of many goods and some services. Sales tax rates can vary widely among different jurisdictions, anywhere from 0% to 16%, and may vary within a jurisdiction based on a certain good or service being taxed. The U.S. does not have a national sales tax, though some nations do. However, the United States does impose tariffs or customs duties on the import of many types of goods from other countries. Taxes are also levied on capital gains or dividends, both of which represent money earned through investment or the appreciation of an asset or property over time. Finally, estate and gift taxes are imposed by the federal and some state governments on the transfer of property inheritance by will or by a lifetime donation. And after that list, I think you're probably beginning to understand why Benjamin Franklin considered taxes unavoidable. Even if you don't have a job or own property, you're likely going to pay at least sales taxes on items that you buy. There are 3 approaches to taxation. A progressive tax is one that takes a larger percentage from those with higher incomes than it does from those with lower incomes. A proportional tax, sometimes called a flat tax, takes the same percentage of income from everyone regardless of how much they make. Finally, a regressive tax takes a larger percentage from those with lower incomes than it does from those with higher incomes. While there's not necessarily a right or wrong type of tax, these are the sorts of considerations lawmakers must take into account when they impose taxes. Income taxes in this country are generally progressive, so those with low income pay less in taxes. Sales tax, on the other hand, is designed as a proportional tax. Everyone who buys things at the grocery pays the same sales tax rate, but in fact this can have the same effect as a regressive tax. If we assume that a family of 4 needs to eat the same minimum amount of food each month regardless of their income, and so they spend the same amount on those groceries at the store, the resulting sales tax would in fact be a much larger percentage of the income for the lower income family than it would be from the family who makes more money. Well, as you know, there are a number of taxes you may pay in your lifetime. The 4 most common ones you'll encounter are sales taxes, property taxes, payroll taxes, and income taxes. In this lesson, we'll focus primarily on personal taxes, which are the federal payroll and income taxes that you as an individual most likely need to contend with regularly. While sales taxes are a common aspect of your life, you pay them almost every time you buy something, it doesn't require you generally to file forms or take any action. It's simply charged when you purchase an item. One thing you may notice about other types of taxes, however, is that there's a lot of forms involved. While most of these are now available electronically, the forms themselves are the same and are important to be aware of and to properly manage, whether you file them in printed form or via the internet. The first thing to be aware of is your Social Security number. You need a valid Social Security number to file taxes. In all likelihood, you already have one because your parents or guardians would have also needed it to include you as a dependent on their taxes. But it's especially important that you know it as an adult and protect it because it is your taxpayer ID number, and you not only have to use it to file taxes, but also every time you start work somewhere and fill out the employee paperwork. Employers will require you to complete a federal W-4 form. This indicates to the employer what your current tax situation is in the broadest sense, whether you're single or married, how many dependents or exemptions you plan to claim. While those terms can be a bit complicated, this form is basically what tells the employer how much income tax they should withhold from your paycheck. Our tax system is a pay-as-you-go system, so for most of us it makes sense to try to withhold an amount that is as close as possible to what our total taxes or tax burden will be for that year, meaning we hope at the end of the year that we don't owe or receive a refund for any significant amount. The next form you'll need to know about is the federal W-2. This is issued each year in January. You'll receive one from every place that you worked in the prior calendar year, and it will show you how much you earned and how much they withheld for taxes and so on. You need every W-2 form from that year in order to file your taxes. So it's always important that if you moved during a year, you update your address with any current or recent employers so that the forms will reach you. Finally, there's the 1040 form. With the 2017 tax reforms, many processes were streamlined, and most Americans now file a standard 1040 form rather than one of the variations that existed in prior years. Depending on individual tax situations, there may be other forms involved, and when you file your taxes, it'll often reference another form or schedule you may need to fill out. But these are the key ones you should be aware of. As we noted on the prior slide, the W-4 tells your employer your tax status so they know what to withhold, while the W-2 tells you how much they actually did withhold. So what is withholding? Well, as we noted, our tax system is set up to pay as you go. For most of us, it would be very challenging to receive every dime of our gross pay in our paycheck, but to save aside the appropriate amount so that we could pay our tax bill in full at the end of the year. It could certainly increase the likelihood that many wouldn't be able to pay and would suffer severe consequences for failing to do so. To make this easier, employers withhold the anticipated amount from your paycheck based on how much you earn, how many dependents you have, and so forth. This allows the employer, or more likely the software that they use, to estimate what your total tax burden or tax bracket will be for that year, and then to withhold it in a roughly equal amount from each paycheck. Your employer also withholds what we know as payroll taxes. This is Social Security and Medicare. When we age, we'll have access to payments from Social Security and to medical care from Medicare's system. What funds those payments is the fact that all employees in the U.S. pay into the system through payroll tax withholding. These are proportional taxes. Every American pays the same percentage. Currently, Social Security is 6.2%, and both the employee and the employer pay that 6.2%, adding up to 12.4% total. And Medicare is 1.45% for each of the employer and the employee. So every paycheck you get, regardless of your tax situation, you will have 7.65% withheld from your gross pay for your personal contribution to Medicare and Social Security. These withholdings apply on every dollar you earn up to an income of $132,900. Beyond that wage, you will no longer continue paying into Social Security in that year, but you will continue to pay into Medicare on every dollar you earn. Self-employed individuals must manage all of this on their own, as they are still required to pay all of the same taxes, but don't have an employer doing the withholding on their behalf. You know that the W-4 tells your employer how much they should withhold, but what is a filing status? Your filing status indicates your legal status in regard to taxes relative to your family situation. There are 5 filing statuses: single, married filing jointly, married filing separately, head of household, and qualifying widow or widower with dependent child. These can be confusing. Obviously, if you're married, you have at least 2 choices. If you're single, you may also be a qualifying widow or a head of household. But how do you know which to choose? It's best to consult a tax professional, or at least to utilize tax preparation software, which will walk you through the various options to determine which is correct for you in a given year. For many young adults, this part can be relatively easy, though. If you're not married and have no kids, you're almost certain to be filing as a single individual. Perhaps most importantly in taxes is the concept of actually filing taxes. The term filing means to prepare and submit your tax return for the year. And note that the word tax return does not mean you're receiving a refund. The return is the documentation itself that you complete and give to the Internal Revenue Service, or IRS, which is the government agency charged with managing tax collections in the U.S. When you complete your taxes, you're likely to either owe some additional tax that was not withheld during the year, or to receive a refund if too much was withheld. You can mail it in or submit your tax returns electronically, but you are required to file on or before the deadline. The normal deadline is April 15th each year for you to file the taxes for the prior calendar year, though this April 15th deadline is sometimes extended a day or 2 if it falls on a weekend. You can do it sooner, as soon as you have all of your documents from your employers, for example, but do not do it later. There are strict and severe penalties for filing late or failing to file, and they could result in your wages being garnished to pay your debt, or even prison, as well as an inability to utilize other federal programs like financial aid and Medicare or Medicaid. If you're going to be late, you should file an extension, but be aware that an extension does not give you additional time to pay if you owe money. It simply means you can file the documentation itself later. But if you think you owe money, you're still expected to submit that payment with the extension. While you might have assumed that people file extensions to gain additional time to pay money they owe, that is not the case. They typically do so because they're having trouble gathering documentation or completing the forms for some reason. In the prior lesson, we talked about certain long-term savings that would allow you to defer income. What that means is that if you receive $1,000 in your gross pay and you have 10% withheld in your 401k retirement fund, you're actually only taxed in the current year on the remaining $900 in income. You won't be taxed on that $100 in income until you withdraw it in retirement. This can be especially helpful not only for saving for your retirement, but also if you expect your tax bill to be very large in a given year. Certain healthcare savings accounts, such as HSAs or FSAs, also allow you to save money in non-taxable accounts. Finally, here are a few things you should know. First, you may not need to file a tax return. Based on your income and other factors in any given year, you may not be technically required to do so. But if you don't file, you could miss out on certain tax credits or other benefits that you're qualified for. So it's always best to work through the process and determine if there's any benefit to filing, even if you don't have to do so. You may qualify for deductions for things like student loans or tuition, and that can lower your tax bill. Penalties and interest are significant for late filing. If you fail to file, you could suffer serious penalties and have to pay interest on every day and every dollar that's late, and the penalties can continue to add up. Contributing to a traditional IRA after December 31st, but before you file taxes, can also allow you to reduce your taxes and at the same time save money for retirement. Failure to file and pay is serious. The government can take drastic measures, including seizing your passport or taking the money from your bank account. And finally, tax preparation isn't always expensive. If you have concerns about doing your taxes right, don't hesitate to consult a professional tax preparer or at least use tax software to help you with the process. It may cost a little, but it likely won't be hugely expensive for you as an individual taxpayer. And given the penalties for a mistake or failure to pay, it's worth getting it right the first time. Now we'll conclude this lesson with a little more work on the W-4 form and a knowledge check to see what you've learned.